Jane Street, Market Power and Bitcoin Suspicions. There is a trading firm few retail investors notice that now ranks among the largest liquidity providers, Jane Street. It reportedly generated trading revenue last year comparable to major banks and is estimated to be involved in over 10% of U.S. equity trades. It is also one of 4 authorized participants, APs, able to create and redeem shares for the largest Bitcoin ETF, IBIT. Authorized participants perform a key market-making function. They keep ETF share prices aligned with spot prices by creating or redeeming shares. APs also have regulatory and operational privileges that limit public visibility into their full exposures. Filings may disclose large ETF holdings while omitting offsets held in derivatives, so reported long positions do not reveal net exposure or hedges. Since late 2025, observers noted a recurring intraday pattern, a 2-3% Bitcoin drop around 10 a.m. ET on trading days, a low liquidity window coinciding with U.S. market open. Those drops triggered forced liquidations and negative feedback loops that amplified price moves. One hypothesis is that a large AP with broad market access could, a. sell spot or ETF shares quickly during that thin window to trigger liquidations, b. profit from short or derivatives positions opened beforehand, and c. buy back at lower prices, repeating the cycle. Others argue the moves reflect legitimate repricing when U.S. markets open or are consistent with delta-neutral market-making strategies that hedge exposure across venues. Additional context increases scrutiny. Regulators in India found market manipulation patterns in trades linked to the firm and barred it from certain markets. Separate enforcement actions in other jurisdictions have alleged similar conduct. A high-profile lawsuit also alleges use of confidential information from a failed crypto project to profit from its collapse. When news of that suit became public, the recurring 10 a.m. pattern temporarily ceased and Bitcoin rallied sharply. These incidents do not prove wrongdoing in every case, but they show repeated regulatory and litigation entanglements that make the manipulation hypothesis plausible to some analysts. Mechanically, the concern rests on 3 facts. 1. APs can create/destroy ETF shares and move large amounts of exchange-traded supply. 2. APs can combine visible holdings with opaque derivatives positions. And 3. Market microstructure includes predictable low liquidity windows where relatively small flows produce outsized moves. Together those elements can enable strategies that accentuate intraday volatility and extract profit from forced liquidations. Whether the episodes reflect illicit manipulation, aggressive market making, or legal but opaque hedging is ultimately a matter for regulators and courts. For investors, the practical implications are clearer. Securitization and ETFs introduce middlemen and operational asymmetries that can alter price dynamics compared with direct spot ownership. If the goal is immunity from intermediated market behavior, self-custody of private keys removes counterparty custody risk and prevents third parties from liquidating your holdings. It does not, however, prevent price volatility. Bottom line, large APs can influence ETF and intraday price action because of their role and privileges. Repeated regulatory findings and lawsuits increase the plausibility of abusive strategies, but firm liability must be determined by enforcement processes. Investors should weigh custody and execution choices accordingly. ETF exposure brings convenience and market access but also reliance on intermediaries. Holding native assets in self-custody preserves control but transfers custody responsibilities to the owner.